Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Q2 2017. My name is Nick Basso, and I am a portfolio administrator in Ironwood's Asset Management Division. And tonight it's my pleasure to introduce the featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type those into the chat box on the GoToWebinar panel on your screen. I will compile the questions and we will do our best to address those at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Thanks, Sean.
Thanks, Nick, and thanks everybody for joining us on the call tonight. With markets at near all-time highs and volatility at 10-year lows, many investors are wondering what they're supposed to do next. Hopefully, tonight's presentation can give us a little bit of an answer to that question and give you Ironwood's thoughts and ideas throughout the presentation here. Get past the disclosures here. Topics to cover. So we still want to, the first quarter we talked about the first 100 days of the Trump administration. So we still want to discuss the Trump administration's agenda and the long-term implications. We've had a couple of things happen recently, so we want to talk about some of those. Global expansion still continues and has picked up a little bit. Central banks and interest rates, I want to talk about that. We haven't talked about banks' balance sheets, so we want to talk a little bit about that. Oil markets and the U.S. dollar, probably getting to the point where we don't necessarily need to talk about those too much anymore, but still want to bring those up. And then once again, want to make sure that we point out some fundamentals of prudent portfolio management, and then also let history teach us a lesson or be a guide. So the new administration's agenda. So if you haven't heard, the House passed by a very slim amount today the repeal and replace ACA with what they're calling Trump Care. Lot of moving parts there. Probably not the same bill that the Senate's going to end up sending back to the House. So at this point, we'll leave it at, so far what's happened is the House has voted to repeal and replace Obamacare. Tax reform, one of the big pieces of tax reform is that it needs to be budget neutral or revenue neutral, excuse me, in order for it to last longer than 10 years. One of the big pieces of that was the replacement of Obamacare and some of the costs that Obamacare added to the budget. And so tax reform really, in order for it to be a little bit more powerful, needed that Obamacare replace feature. Infrastructure spending, regulatory reform, reworking trade deals, and immigration reform. These are all on the new administration's agenda. Tax reform is one that just a few days ago, the new administration put out kind of bullet points on what they'd like. It was very similar to what the Trump campaign trail had put out. So I want to kind of go through this just a little bit. Not a lot of detail, so it was really high level. But what they proposed, or what they're looking to accomplish, is one, to simplify the tax system on the individual level, replace the current 7 tax brackets we have with 3 brackets. They did not really explain where those brackets would be, what the income thresholds of each bracket would be, but they did say that the brackets that they want to propose are 10%, 25%, and 35%. They want to get rid of the Obamacare 3.8% tax on small businesses and investment income. They want to get rid of most deductions with the exception of 401k deductions, mortgage deductions, and charitable deductions. What they haven't really told us, like I said, is the income at each bracket. So where does the 10% bracket end, and where does the 25% bracket begin, and where does the 25% bracket end, and where does the 35% bracket begin? So they haven't told us where they propose those brackets start and stop. They have not made it clear if state taxes were going to continue to be deductible, which for states like California and New York, if those state taxes are not deductible, it could change the way state taxes are levied. It could make for states to, it could really shove the states into reforming their own taxes as well. Because if you know you're paying 9% in California and you're getting a federal tax deduction, you know, in essence, the federal government is paying some of those California taxes versus a state like Arizona where you have 4% or 4.5% state taxes. So you're not getting that as much of a federal subsidy if those deductions are not allowed anymore. It's going to really change the dynamics there. So things that we want to make sure that we are aware of. On the business side, this is probably the bigger change of the two. They want to drop the business tax rate from 35 to 15. They want to go to a territorial system. They want to do a one-time tax on a bunch of money, trillions of dollars that's held overseas. And then, like I said before, they want to repeal the 3.8% Obamacare tax that does hit some small businesses. They also want to get rid of AMT, and they want to get rid of the estate tax. So those are some big points of the tax reform. We're not exactly sure what of those reforms we'll get and how this will evolve over time, but definitely a large tax cut when you look at it in aggregate. So what are some of the implications of some of this new administration's agenda? Well, it's going to possibly be inflationary. Hopefully it would add to growth. Now, whether that's permanent growth or whether that's taking future growth and bringing it forward, that's one of the big questions that's out there. If it's more permanent growth, then maybe you can pay for some of these cuts with the permanent growth, which is one way of looking at it. Another way is if the growth is not permanent and it's more temporary, then all you're going to do is end up increasing the deficit, which is the next line item here, in the future. And if we do see growth, even if it's permanent or if it's pushed forward or pulled forward, I should say, and inflationary issues, you're probably going to see the Fed move a little quicker and probably looking at higher interest rates sooner rather than later. So that's the new administration, and that's more domestic focus. But one of the things that we have noticed is that the global economy has picked up significantly over the last few months. This graph here shows the different colors, green being really good, yellow being and then orange and red being not so good. And you can see that in a lot of the developed countries, we're starting to see winter grass as opposed to summer grass. If you're from Arizona, you'll understand the difference between those two. But the darker greens are more prevalent. And then when we look at global Pop Managers Index, you see we're at 53, which is the highest since February 2014. If we want to focus more on how the U.S. is doing in particular, 10-year Treasury at the end of the quarter was at 2.4%. That's up from 1.6% before the election. As of today, it's at 2.35, so it hasn't changed all that much since then. ISM manufacturing, both in March and in February, were fairly strong. 57.7, 57.2. Non-manufacturing in March was 55.2, which gave us 87 months of expansion in the non-manufacturing PMI. In March, we had a little bit of a slowdown in the terms of job creation. The economy only produced 98,000 jobs, or at least that was the first take. We'll get a revision to that tomorrow, and we'll get April's numbers tomorrow. The unemployment rate lowered down to 4.5%, and the 3-month average job growth is just under 200,000. The U.S. job market is very tight. We'll go into that a little bit more in detail on a future slide here, so I'm not going to go into that too much here. But the U.S. economy, these numbers are not off the charts, but they're humming along. We're not doing horrible. We're doing pretty good. One of the things that's kind of dislocated right now is, since the election, we've had soft data, which is business and consumer surveys. So, the business sentiment numbers, the consumer sentiment numbers, they have been, you can see after the election last year, they have really jumped up significantly in a very quick period of time by this gray line here, soft data. But the hard data by the blue line hasn't really moved all that much. So the hard data is the actual data, the GDP numbers, and there's this dislocation. And so that's one of the things that economists are trying to figure out is, did people just get really optimistic about the new administration's growth plan, and growth hasn't really kicked up, or is growth coming? So that's something that we'll need to keep an eye on as well, as some of these policies actually go into effect, and some of this deregulation does start to happen. The economic expansion still very slow. We've had the last, this recovery has been long, but it's been very slow, as you can tell. GDP growth is only right around 10%, whereas in the past we've seen 25, we've seen 30, we've seen 35, we've seen 50% growth in GDP after recessions. You could make an argument that we should have a long recovery, given the fact that if you look at how bad the recession was, it was way worse than even the worst recession previously, and a lot longer as well. So you would expect that the recovery would take a little bit of time as well. The cumulative GDP growth, though, at around 10, 12% since the recession, that's really anemic. And that's really what the new administration is trying to create growth. They want to see 3% GDP growth instead of what we have seen, which is closer to 2% over the last, call it, 8 years. A lot of folks are saying that this recovery, this bull market is long in the tooth. As the previous slide shows, we are getting to the fact where number of quarters, we're getting to the point where it is a long expansion. But if we look at the stock market, which is this next slide, we can see that the current bull market is at 97 months, which puts us about right in the middle. We've got 5 that were shorter, and we've got 4 that were longer. And so we're right here in the middle. The average length is 92 months. We're at 97. And then when you look at the price gain of the S&P 500, we're at 257, or I'm sorry, we're at 222%. The average price gain is 257. So once again, we've got 4, we're doing better than 4 of the previous bull markets, but we're doing worse than 5 of them. So just because this is a long in the tooth as far as time goes, it doesn't necessarily mean that the stock market couldn't go higher. And so that's one of the reasons I wanted to put this slide in here. With that said, we're definitely not at the beginning of this either. A huge correction could equate to a longer, more fruitful recovery, but it's hard, if not impossible, to know what's coming next. I just put this in here to say that it doesn't necessarily, just because we're long in the tooth, quotation, doesn't necessarily mean that the stock market couldn't go higher. And I hear that a lot. People are saying, well, the stock market can't go higher because we've already gone a long way. Well, we've gone about average. So we have to be careful at this point, but it's not inevitable that the stock market is going to go down from here. The labor market. I want to go back one slide. The labor market is very tight right now. As you can see, we're pretty close to full employment, if we're not there already. At February was 4.7, but March's number was 4.5. We've had wage growth of 2.6% actually. The private sector wage growth has been the highest it's been in 10 years. So that's another inflationary type pressure that going forward could hurt earnings, because if wages are going up, that's gonna dig into earnings or profits. But the labor market is very tight, and to think that we're going to be able to get it much tighter, one of the things that's probably going to have to move is this wage growth. If we look at the Atlanta Fed, they actually exclude workers that have been added within the last 12 months, and they come up with a wage growth that's closer to like 3.5% when they exclude the folks who have been added within the last 12 months, which is a lot of economists look at that as a more accurate or more reliable number when looking at where wages are going. So those are fairly positive numbers, inflationary. So we want to make sure that we're aware of that. Cyclical sectors here in the U.S., the light vehicle sales actually has come down a bit. 2016 was a record year at 17.55 million units. Thus far, in the beginning of 2017, we have had a little bit of a downtick, but nothing falling off of a cliff or anything like that. But it has been a little sluggish, which we would expect after such a great run from autos. Housing continues to tick up. Inventories continue to come down, which is a positive thing. That means we have to rebuild those inventories. This is one of the reasons that that a lot of economists are citing for the weaker than expected GDP numbers that we've seen over the last quarter. And then real capital goods, you can see that we're coming down, and we've had a little bit of a turn here since about election time, where real capital goods orders are starting to go up a little bit. So that's a positive as well. The consumer looks great. The consumer is probably the best piece, and in the third and fourth quarter of 2016, GDP, the consumer added pretty good numbers to the GDP. First quarter, consumers were a lot less than expected out of GDP, and so that's one of the reasons that we saw GDP growth of 0.7% in the first quarter, or at least the first estimate was 0.7, and a lot of that had to do with consumers not growing as much as they had the previous 2 quarters. That could just be a lot of spending in the holiday quarter last year, and consumers just kind of getting back into it. But you can see housing affordability is still good. Net worth is at an all-time high. You know, with stock prices where they are, with housing prices where they are, we're at an all-time high. And then you couple that with low debts outstanding, low liabilities outstanding, consumers looking pretty good. It's a great job market. Housing still affordable. Gasoline prices fairly low. So the consumer, which is the largest piece of the U.S. economy, we believe is doing very well and will continue to do very well in the foreseeable future. Okay, so that's the U.S. So we talked about the global economy being a lot more positive. So if we just looked at the U.S., which is a big portion of the global economy, now we want to look at some of the other areas outside the U.S. And here we go, global reflation. And you can see here that 2017, these are estimates, but we've got a much higher estimate for global GDP, and you're starting to see inflation starting to tick up a little bit here. Corporate profits tend to follow GDP growth. So we're starting to see GDP growth going the correct way, which could be positive for corporate profits. If we dig a little bit deeper and we look at European recovery, we're talking about the best European numbers that we've seen in over 7 years. You can see their job market has also been improving, although they're still at 9.5%. They still have some room to further improve their employment situation. GDP and market PMIs, or the manufacturing PMI numbers, look very positive in Europe, and then we've got better credit demand also. Japan has a pretty massive fiscal stimulus going on. Their numbers have not improved as much as Europe, but they are improving, albeit slowly. And then China has done a lot of improving since 2016, and you can see, you know, the domestic car sales here. Although we took a little drop early in the year, we had gone up a lot the last few years, and you can see this big reversal in 2016 and 2017 in manufacturing and in services. So China is becoming one of the larger parts of the global GDP. It now represents 15% of global GDP, when just 10 years ago it was only 5%. So much larger economy, and we've got to make sure that we're paying attention to how China's doing. Central banks and interest rates. I know I've hit on this in previous calls, and many of you are probably tired of hearing me say this, but we've been in almost a 40-year bull market since the 80s, and it's hard to, with everything that's going on, it's hard to see interest rates, especially real yields, being able to stay at these low levels. And you can see here, when the election happened, the bond market really priced in a lot higher rates a lot quicker. And that you can see that spike. Even on this long chart, you can still see that's a pretty big spike there. We went from 1.6 on the 10-year Treasury before the election to 2.4% as of March 31st. So this is going to only, in our opinion, this trend is only going to continue upward because the Fed has talked about 2 more interest rate hikes for the remainder of the year, and they've also started, and this is something that not a lot of people are talking about, but they just started to talk about reducing their balance sheet. Now, central banks across the world increased their balance sheets by $10 trillion during the recession. It went from roughly $4 trillion to roughly $14 trillion. That is going to start to reverse, and as that happens, liquidity is going to be mopped up in some of these areas, and we believe that that's going to have a negative impact on interest rates. We believe that's going to continue to increase rates, which in the short run is negative to bond portfolios, because as interest rates increase, if you own a bond, that bond is going to become less valuable. The determinant of how less valuable that bond will be has a lot to do with what the maturity or the duration of that bond is. The longer the duration, the more the principal is going to be affected if interest rates increase. So that is one of the reasons that our bond portfolio is positioned with a very short duration. You can see that the difference between the yield curves here from December 31st, 2013 to March 31st, 2017, the yield curve is starting to flatten, which is exactly what we would expect. We would expect this long-term yield, though, to go a little bit higher, and I'll show you that on the next slide here. But before I do that, so the negative is bonds taken on the chin early when interest rates increase, but what happens after that increase in interest rates is new bonds start to pay more. They start to pay more interest. Well, if you look at the U.S., household interest is about $1.4 trillion in income versus about $350 billion in expenses, in interest expenses. So as interest rates increase, that's going to help the investors, the U.S. investors who are relying on interest rates, whether it's through pension funds that are invested in fixed income that's now paying higher, whether it's through a 401k that has fixed income in it, an IRA that has fixed income in it. The retirees who have saved all this money and need to live off of it, they need that interest income to be higher in order for them to live their lives and buy things and do the things that they want to do. So the low interest rate environment that we've seen over the last 10 years or so has really been a silent tax on savers. And so that's the positive, is that when interest rates go up, those savers now get paid more interest for their assets that they hold in those income generating assets. Now back to my flattening. So this is the last 5 rate hike cycles, and in every single one, the whole curve has shifted up, and it's also flattened. So if we've got a 10-year treasury right now, or I'm sorry, a 30-year treasury at 3%, we would expect that would go up, and we would expect that the whole yield curve would flatten as well. So you're already starting to see it a little bit here from where it was before. So that's kind of what we expect from central banks, not only the U.S., but likely the ECB, likely the Bank of Japan. The global economy picking up is going to force these countries to start looking at their monetary policy a little bit more closely. Oil markets and the U.S. dollar, we talked about this a lot in past presentations. One of the big, in 2014 and 2015, a big headwind to earnings was the fact that the dollar went up, 20+% in a very short period of time. This is the dollar right here in blue. And if we look at that and we compare that to oil prices, we get exactly the opposite in oil prices. Oil prices did an exact plummet during about the same time. And you're probably asking, well, Sean, why does that matter? Well, we had an earnings recession in the U.S. And outside of the U.S. And a big part of that, in fact, the U.S., all of the U.S.'s negative earnings came from these two factors. More than 100% of the negative earnings growth that we saw came from the U.S. dollar and the headwinds that it created, and the energy prices, the energy sector. You can see that in 2017 and 2018, because these factors have started to stabilize, I think as of today we're about $46 a barrel. It's not at 111, but it's also not at 30 or 26 where it got below. Oil is kind of stabilized here, and then also the dollar has stabilized, and in fact this year it's come down even a little bit more, so it's stabilized over the last year and a half or so, which is going to stop the negative earnings from happening in those two sectors. So that's positive for earnings. How to navigate. So we've got all this stuff that's going on, and we need to know exactly how should we be avoiding some of these pitfalls. How can we take advantage of some of these opportunities? Well, we want to make sure that we know everything that's going on. So the first thing is that there is a lot of cash on the sidelines. You can see that this number, we've been tracking this money, M2 money supply as a percentage of nominal GDP for a while now. The average is 54%. We're at 70%. There's a lot of cash on the sidelines. And over this entire period, so this is about 2010, 2011, if we look up here, 2011, it's not paying us anything. We're losing to inflation. Income needed to beat inflation. We lost. These investments cannot continue to lose to inflation. These are institutions, these are retail clients that are just keeping cash because it's safe, and they got burned so badly in the financial crisis that they're positioned very conservatively. We're starting to see some signs that we're allowing these folks to be a little bit more aggressive with these assets. So maybe they're going into some fixed income. Maybe they're going into stocks. If we see a reduction in this percentage, and it does go into bonds, it does go into other asset classes, that is going to be a tailwind for assets. Now, this is probably out of all the slides, this is one of the most important slides that we have, in my opinion. And what it's trying to say is that if we looked at the S&P 500, instead of looking at it as an equity, we said, okay, we know that we're going to get the earnings from these companies. Let's just say the S&P 500 is a company like Apple. It's 500 companies, but let's just think of it as one company for a second. And let's say the price of this one company is $100. Well, if this company spits off $6 in earnings and profits per year, and its price, I can buy it for $100, Well, it's paying me 6%. That's exactly what this S&P 500 earnings yield is. It's just the inverse of the PE. So the PE would be, in my example, 6 over 100. I'm sorry, the PE would be 100 over 6, would give you that PE multiple. But if you flip it upside down, you get 6%. Well, that's pretty much where the S&P 500 earnings yield is. It's 5.7%. So if we look at the S&P and know that we are entitled to those earnings that the S&P 500 company, in this example, we're looking at as one company, we're entitled to that $6 worth of earnings. And as long, if we don't really care what that $100 does, it can fluctuate all over the place. But if we get that $6 each and every year, then you're looking at it more as a bond. And that's exactly what this chart does. And so we compare a more aggressive bond yield, the Moody's BAA yield, which is 4.6%, versus the earnings yield of stocks of the S&P 500. And you can see that we're getting a full percentage point more on S&P 500 earnings yield than we are the Moody's BAA bond yield. Now, if we go back in history and we look at a couple of times, let's look at 2000, right before the dot-com bubble burst. You can see that there was a huge gap. The bond yield was over 8% here, whereas the earnings yield was, call it 4%. So we had a 4, maybe 5% advantage to bonds. What this tells me is that during this period of time, bonds were a lot more attractive than stocks. However, it was very difficult to tell investors at that time to go take their money and buy bonds, because bonds were only yielding, you were only getting 8% from your bonds. During that time, there was a 3-year period where the S&P 500 was up like 30% per year for 3 years in a row. And so for an investor, it's hard to say, okay, well, why don't you buy this bond index instead? It's going to yield us 8, and it's going to be a lot safer than buying the stock that over the last 3 years has given us 30% returns each and every year. And then we all know what happened. Stocks collapsed, and that's when you start to see this earnings yield go up. And so another period, another recession, we had a huge gap here also, but it was the reverse. And if everyone could go back to 2009, 2010, 2011 and say, what was the right thing to do at that time? The right thing was to take conservative assets and buy aggressive assets. Now, it was really hard to do in 2009, 2010, because the economy was fluctuating so much, and we had so much negative news that was coming out. It was very hard to go out and do that. But those are the things that this is a perfect graph that shows those longer-term trends. We still have a gap here, which tells me this is a very long-winded way to say we believe stocks are more attractive than bonds. That's all we're saying when we show this graph, but I think it's a really important one, and that's why I just spent so much time on it. Earnings. First quarter earnings have been very, very good. We are currently about a little over 20% higher than we were in the first quarter of 2016. And even with some of these aggressive analyst estimates, this is a chart, this is showing about 66% of the S&P 500 companies had reported as of this chart. 79% of those were beating analyst expectations on their earnings per share. So this is what we're entitled to, remember. Here's our earnings recession here. This is when the dollar and oil did very poorly. in a lot of markets outside of large cap domestic, so outside of the S&P 500, you basically had a bear market, small cap bear market. Many international countries, bear market. Emerging markets, bear market. We had bear markets in 2015 and 2014 because of that high dollar and those low energy prices. And since then, we've had an earnings recovery, and now we're beating analysts' expectations by a significant amount. I mean, if you look at this chart now, the revenues number is a little bit more choppy, but the earnings number, you see kind of, okay, we're right around 70, 66, 73, 70, 70, 71, 70, boom, 79%. That's a big number. That's a lot of companies that are beating earnings expectations, which over the long run, earnings are what drive stock prices. So if these analysts' expectations are lower than what truly happens, then possibly the stock market has a little bit more room to run. Internationally, kind of the same story. We have an improving earnings cycle. The U.S., we're at all-time high earnings, whereas Japan, we're getting back there, but emerging markets, we're nowhere near the peak post-crisis, and Europe, the same thing. And because of this, one of the reasons that some of these areas are a little bit more attractive is because they have not had the great earnings recovery that the United States has had. You can see that in the valuation metrics. So the U.S. valuation metrics is up to 17.9 when the average is below that. Developed markets is at 16.8, pretty much in line. Europe, 14.9, pretty much in line. Japan, a lot lower than the average, and then emerging markets lower than the average. Now, with interest rates as low as they are, you could make a good argument that valuation metrics should be higher because your cost of capital is so low. But even taking that out of consideration, you just look at this and you say, okay, well, the U.S. market is not as attractive as emerging markets. And then you throw in, if emerging markets gets back up to the earnings that they had in 2011, 2012, well, wow, that could really make the prices of emerging markets companies go higher. So there's a couple things at play. We are a big fan of emerging markets. We are a big fan of equities outside the United States. A portfolio that is diversified, so we're sticking to fundamentals. That's what this whole section is about. It's not always about the S&P 500. It's not always about large cap U.S. companies. They have done fantastic over the last 7 years. And our portfolios have benefited because the S&P 500 is up as much as it is. Because we have a large percentage of our clients' assets in domestic equities. But a diversified portfolio should also have a lot of exposure outside the United States. One of the things that shows this bias is this chart that I really love this chart. It shows the investment universe and U.S. investors. So it shows that if we look at global GDP, the U.S. makes up 22% of global GDP. If we look up at global stock and bond markets, the U.S. makes up 36% of the U.S. stock and bond markets. Then we look at U.S. investor allocation, 75% almost of a U.S. investor's allocation is in U.S. stocks. If we take this a step further and show country bias, we can do this by separating the U.S. out to different regions. In the East Coast, we have a lot more financial companies, and a lot of folks know the financial, they think they know what's going on in financials a lot more than the rest of the United States, and they overweight financials to their portfolio because that's what they know. U.S. investors know U.S., they overweight U.S. The West Coast has a technology bias. Well, that makes a lot of sense. The South has a lot of energy bias. That makes a lot of sense. Industrials in the Midwest has industrial exposure. That makes a lot of sense. So it makes sense that U.S. investors, their largest holding is U.S. stocks. We want to make sure that we're not neglecting outside the United States, especially when we believe that those areas are a lot more attractive because of what's gone on. Commodities, another place that's just absolutely got hammered over the last few years, and you can tell that by the prices. Most of these commodity prices are lower than their recent historic levels. The Bloomberg Commodity Index, which is a diversified commodity index, it's at 85.4. The low 72, 73, call it. The high is 238. We believe that commodities prices are lower than they will be in the future, and this adds a lowly correlated asset class to our portfolios, which is always a good thing when you're a portfolio manager, to add non-correlated assets. And I'll get into the reason why a little bit more during a later slide here. Bonds, even though we don't like bonds and we prefer stocks over bonds, it doesn't mean that we want to abandon bonds, because depending on each of our clients' goals and objectives, they probably need bonds in their portfolio. If we had a portfolio and we invested the portfolio at the worst, basically the worst time to invest, October 2007, the last peak of the S&P 500, if we had an all S&P 500 portfolio, that $100,000 portfolio would have lost over $50,000 by the bottom of the bear market, the Great Recession. And it would have taken 4.5 years from when you invested the $100,000. It would have taken 4.5 years about in order for us to have gotten back up to $100,000. So if you don't have 4.5 years before you need money, you probably need a more conservative portfolio. So if we go to the other extreme, which is 40% in stocks and 60% in fixed income, you can see that if you invested all of that $100,000 at the worst time, you lost a lot less. Your portfolio never got below about $80,000, and then your portfolio basically was back to $100,000 in 2 years. So let's say you have a year's worth of income in cash, maybe 2 years worth of income in cash. You're getting some dividends and interest from the portfolio, and it's back to where it was in 2 years. So that's not gonna cause you a lot of angst in that situation. It's not to say that this is going to happen tomorrow, but it could, and that's why we want to make sure that we don't abandon fixed income. Fixed income is one of the only negatively correlated asset classes that we can add to a portfolio. The other thing we want to do is we want to make sure that our emotions don't get the best of us and that we're not chasing returns. So this graph just shows the average investor. This is a survey done by Dalbar. They update this every year. The average investor gets 2.1% return. I can tell you they take a lot more risk than what's necessary to earn 2.1%. If they just bought a 40-60 portfolio or a 60-40 portfolio, or they just bought the S&P 500, they would have been a lot better off than trying to time the market, which is what a lot of individual investors do, or they try and chase returns. So we want to avoid those emotions as well. So I said I would go into it a little bit more in detail on why negatively correlated and lowly correlated assets are good to add into the portfolio. This slide right here shows exactly why. I've got the risk of emerging markets from 94 to 2015. Emerging markets were very risky. Annual volatility, very high. Annual excess return, not very high. So the average return per unit of risk, so every one of these, for every one of these, we get 0.07. We get 0.07 return for every unit of risk we take. That's not very good. But that's the Sharpe ratio of emerging markets over this 20-year period of time. Developed international, we took a pretty good amount of risk, didn't get a great return, a little bit better Sharpe ratio than emerging markets. Notice emerging markets had a slightly better return, but they had way more risk. And so the Sharpe ratio is lower for emerging markets during this period of time than it was for developed international. We move to Russell 2000. We have a Sharpe ratio of 0.34, a little bit better. S&P 500, 0.38, even better. If we combine a bunch of different asset classes, 25% S&P, 10% small cap, 15% developed international, 5% emerging markets, 25% Barclays global aggregate, that's bonds, 5% basically a little bit better than cash, and 5% market neutral, 5% commodities, and 5% REITs. If we add all of those together, we took less risk than all four of these, and we didn't give up a lot of return. And therefore, our Sharpe ratio is much higher. It's the best Sharpe ratio. So you're getting the most return out of every unit of risk that you're taking. That is why those negatively correlated and lowly correlated assets are so good to add to the portfolio. This is the last 10 years here, or not the last 10 years, but 2005 to 2014. This was our risk against our return. So we've got cash, bonds, market neutral, merger, arbitrage, distressed debt, private equity, S&P, global equity, developed international, emerging markets, small cap, real estate, MLPs, commodities. The problem is this 10-year period of time here. The problem is we don't know what the next 10 years is going to give us. We can guesstimate what the next 10 years has given us based on a whole bunch of different inputs, but it's not going to be exactly what it was the previous 10 years. I can almost say that for sure, that it's not going to be exact. You're not going to get the same exact chart that you got over this period for the next 10 years. And because of that, you want to make sure that you're putting these asset classes together in a correct way where you think you can get the highest Sharpe ratio going forward. This just shows annual volatility. We haven't seen a lot of annual volatility this year. In fact, like I said at the beginning of the presentation, volatility as measured by VIX, daily volatility, measured by the movement of stocks, it hit the lowest level in 10 years. The biggest correction we've seen thus far this year has been 2%. You can see even with some of the good years, we had more than 2% correction during the year. And in fact, over this 37-year period of time, the average correction inside of a year is 14%. So the problem is we don't know if we're going to go up 30 before we come down 14. So it's very difficult to even try and time the market, and everyone says, oh, I'll wait until there's a pullback. Well, if we would have said that we're going to wait for a pullback, you've got to time it almost perfectly over the last 7 years, we had a 16% pullback in 2010, a 19.4% pullback in 2011. When do you jump in there? It's difficult because is this going to be the next recession? You never know. 10% correction, 5, 7, 12, 13, and we really haven't had one for a while. So there's been a lot of people that got out of the stock market at some point in time waiting for a correction, and they just keep waiting. And if we have a 5 or 7% correction, they would have given up 15 only to buy in 10% higher than what they sold out at a previous time. So it's very difficult to time the market. That's all that these two slides are trying to show. And that's why we come back to we need to make sure that all of our investors have the correct time frame. We are pretty much at all-time highs on a lot of different areas of the stock market. Now would be a great time if you've got expenses that are coming up within the next 2 years, maybe even 3 years. It might be time to ring the cash register and say, you know what, let's take some profits from the portfolio. Let's put some of this money in cash and let's live off of it for the next 2 or 3 years. If you're more aggressive, you might say 2 or 3 years in cash is crazy, and I'm okay with it being exposed. But the reality is, over a 1-year period of time, if we're looking at stocks, the best return is 47%. The worst return is negative 39%. When we work with clients, we're working with clients to make money over the long run. So if our client comes in and says they have a 1-year time frame and negative 39% is a possibility, we can't be invested in stocks. Even if we look at an all bond portfolio, negative 8% is the worst year in bonds. Best is 43. If somebody has a 1-year time frame, they shouldn't be in bonds either, because we've had years where you're down 8%. 50-50 portfolio, negative 15 is the worst. So, a 1-year time frame, probably not a good time frame to be putting that money, if it needs to be used within a year or two. Stocks, bonds, or any type of portfolio probably is not the best bet. If we have longer, 5 years, 10 years, 20 years, now we can start talking about stocks, bonds, and a diversified portfolio. If we've got 5 years, we put it into a 50-50 portfolio. There has not been, since 1950, there's not been a market, a 10-year period, where you would have averaged a loss in a 50-50 portfolio. Now we're talking, because now we can work with our clients to say, over a 5-year period, we have a 50-50 portfolio. There's a really good chance you're going to make money in this 50-50 portfolio. And right now, with where cash is at, you're probably going to do a lot better than cash over 5 years. But over the 1-year period, I don't know. Who knows? You give me 20 years, now we even have a more conviction that we're going to make money over 20-year rolling periods in a diversified portfolio. So this just says, make sure that when you have a use for cash, for money, for portfolio assets, make sure that your investment lines up with the use of those funds and when you're going to be using them. The last couple slides here, just kind of showing going back to that retail investors' biggest mistakes, they tend to chase returns. And like I said before, there's been a lot of talk of the S&P 500 and how well it's done. Well, if we take it back to 2007, out of these markets here, some global stocks, the S&P 500 has done the best. And if we take it a step further, it's had the lowest volatility. So this tells me that just out of these 6 markets, equity markets, I can already tell that if our annual return is 6.9 with a volatility of 16, the S&P 500 is going to have the highest Sharpe ratio over this time frame of any of these equities. However, we don't know what the next 10 years is going to bring. And if we just extend this 5 years to 2002, we get a completely different story. So let's look at that time frame. And my slides don't want to go. There it is. Okay, so this is 2002. So just we added on the first 5 years here. And you can see that the S&P 500 now is not the highest returning sector. REITs, emerging markets, 10.8, 9.8, high yield bonds, 9.2, small cap stocks, 8.5, and then this thing that's called the asset allocation portfolio, 6.9, and then you've got your S&P 500. So this asset allocation portfolio is a combination of all of these assets, kind of similar to the asset allocation portfolio that had the really good Sharpe ratio in the previous slide. Well, our asset allocation portfolio over this time frame, 2002 to 2016, returned 6.9%, outdid large cap U.S. by 0.2%, and took about a third less risk. So instead of 16 standard deviation, it had about 11 standard deviation. So the Sharpe ratio of that is going to be a lot higher. That is what portfolio management is all about. We want to make sure there's no pattern on this chart. There's just no pattern. In fact, the only pattern that you can really see is the one, some of the asset classes that did really well and that are our high flyers also end up down here on the bottom. Commodities, commodities, commodities at the top. Commodities, 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 commodities at the bottom. Emerging market, 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 emerging market. So asset classes on an annual basis, the aggressive things, if they do really well, they do really well. If the markets do really poorly, the aggressive things do really poorly. If we're able to put them together in a fashion that's prudent, we can kind of stay in this middle zone here, which is just like what we want to do when we're golfing. We want to keep it in the fairway, and that's what that asset allocation portfolio does, is it keeps us in this fairway. And then when you look at the annual returns over a long period of time, you get a very good risk-return relationship. That is what we're trying to do, and that's why we want to make sure that we're not chasing these S&P 500 returns. Hopefully that makes a lot of sense. With all that said, our overweights, commodities, gee, I wonder why. Maybe because we think that they're underpriced, they've done poorly over the last 4 years. They're probably due for a good year at some point here in the future. Developed international, we already talked about that. We think they're more attractive than domestic equities. Market neutral, we think that's a better spot to be maybe than an all bond portfolio. We throw in some market neutral that has similar types of risk characteristics, but is not interest rate sensitive. Emerging markets, same as the developed international, they've got more value there. Small caps, we think small caps with the administration's agenda could do okay. Underweight, long duration fixed income, you know the story by now on that. Domestic equities, although we like equities, we prefer international. It doesn't mean that we're way underweight domestic. We just we prefer international, and so we tilt the portfolio, the equity portfolio, toward those emerging markets and developed international equities. REITs, as interest rates increase, both REITs and utilities tend to not do as well. Folks have been reaching for yield in both of those, and as bonds pay higher rates, people are going to move from these to fixed income. And then the U.S. dollar has had a really good run because of the thought of monetary divergence, and we think that that's probably a little overblown. So those are our investment implications. With that, I noticed a lot of A lot of hands went up during the presentation, so I'm going to go ahead and have Nick take questions now.
Okay, thanks, Sean. I'm going to start off here with the first question. If you could explain how much of the M2 money supply is overseas.
So the M2 is a domestic reading. So that's going to be all domestic.
Okay, question number 2. If holding cost is losing to inflation, what can we invest the cost in that is low risk and very liquid?
And that's the hard part. That's where there's no silver bullet. When interest rates are low and inflation's also low, but you're when you have cash, you're in essence making the conscious effort to lose to inflation in order to stay liquid. And so there are very few liquid, very safe returns that are going to beat inflation. And that's why you put together a diversified basket of asset classes. That may be, okay, we're going to put together a portfolio that's 30% aggressive and 70% safe. And the expected return from that portfolio is 1% or 1.5% above inflation. And so inflation is our starting point, where it always is when we're looking at investments. Inflation and the risk-free interest rate is always the starting point. Then in order to earn more than that, you have to increase your risk to get a higher return. And that risk can be offset by using portfolio management, but you're still putting yourself at a 2008 at the risk of 2008 happening, and even a 30-70 portfolio would have likely lost between 15 and 20%, call it closer to 15% during that 2008 crisis. But if you're trying to earn the income from it, yes, the portfolio value might have fluctuated during that time, but you're still getting dividends and you're still getting interest from those investments, just like you would had you had that investment in cash. And then 2, 3, 4 years later, your return is much better than cash and much better than inflation during those periods of time, the longer you give it.
Okay, question number 3. So far, we've seen little movement on money market interest rates. When do you think this might move?
We've seen a little bit of movement here as the Fed increases the Fed funds and as they reduce their balance sheet. They've only done 3 hikes, so we're only at 75 basis points. As they move, I would imagine that those bank products, those money market interest rates, will start to increase as the Fed increases rates. They're usually a little bit of a lag. The loan products, the equity lines, they all move. Right when the Fed increases, those move because they're tied to LIBOR or they're tied to the Fed funds rate, and those move immediately. But some of the money markets are a little bit more sluggish. But I would say that when the Fed funds rates, I would say by the end of this year, we'll start to see money markets. Fed funds is at 1.25. I think that we'd start to see money markets start to move up a little bit once we get to about 1.25.
Okay. Well, that's the last question we have for the night. Sean, do you want to give some concluding remarks here? We want to thank everyone and invite them back.
Yep. Thanks for calling in tonight, guys. We'll do another one of these here in 3 months. And if we don't see you, enjoy your summers. Hopefully everybody's got some nice trips planned to get out of the heat if you're here in Arizona. If you're not, we're all jealous because it's really hot here. And we'll be talking in about 3 months. Take care, everybody. Bye.